subscribe now and press the bell icon. Never miss an update.
So we'll start with AMT, which clearly, as it says, it stands for alternative minimum taxes. And the same concept lies also in India, right? Can you tell me what is it?
AMT and MAT also.
Sorry, what is it called?
AMT and MAT.
AMT and MAT, yeah.
Yeah. So the US has, obviously every country has some kind of AMT system that tells that there is certain minimum taxes that any taxpayer has to pay. So we don't have to worry about corporations at the moment because TCJ is effective until 2025. Okay, to boost US economy. That was the biggest slash. The whole corporate rate taxes were cut down from some 30+% to 27% in 2017. That was a big landmark. And how we used to say, oh yeah, go to Mauritius, go to some other Ireland or those kind of countries where taxes are very low. So US also started coming into that category because 21% is still considered to be very low flat tax rate. But for individual, no, the AMT is still applicable. And how do we do AMT calculation? Obviously, we first look into the taxable income. Okay, we have to add up all the tax preferences. That means any items that is giving benefit by reducing the taxable income. Those are called tax preferences. Add up that, because what we are trying to do is we are trying to increase the taxable income to AMTI income. So AMTI is higher than your regular tax. AMT is higher than your regular tax. That means there is a gap and the AMT will be applicable and taxpayer has to pay more amount. For every year, this keeps changing. For 2022, this is the phase out amount. If the person is single, having an income of so and so, then only AMT will be applicable. If the income is below that, it doesn't matter what the ratio of deductions to income is. And above that also, there's a 25% phase out. So for every dollar of increase, 25 cents we have to see. We have to do the phase out calculation. And any income which is above $539,000 for single income, there is no relief available at all. There is no exemption. Straight away that income will go for AMT calculation. So this, you can see that these are all exemption amounts. If the person or the family is earning below certain amount, that's not the intention of US government to put them into AMT situation and ask them to pay more taxes. Again, when we are doing it manually, we obviously need to know all the list of the items, what should be added back, what should be deducted and all. But most of the time when you're running it into the software, it will do it automatically. But we should be knowing why AMT is coming up. So we can give the right answer to the client that, okay, your income is above so and so level. That's why you're falling for it. And the deductions are very high this year. This is the reason probably you're falling into AMT category. So what is AMT? This is the same thing what they're writing here. It is the taxable income after certain adjustments, tax preferences, and those stuff. So the same way, NOL also gets adjusted. Okay. And that's why when we are preparing the return of any new client, we need to thoroughly understand what has been done in the past, because our software will not have all that information. If it's a repeating client and if we are rolling forward the file, the software will automatically roll forward all the carryovers and everything. But it becomes our additional responsibility to go over each and every page of the last file tax return to understand if there is any carryover, if there is any adjustment that needs to be made which is coming from prior years. We should also try to that. I don't mean to say that if you are working on a repeating client, just ignore this part. So it's not like we just look into W2, 1099 and done, put in those numbers and forget about the rest. No, we have to thoroughly first understand what has happened in the prior years. Okay, then there's something called AMT foreign tax credit as well. So foreign tax credit also, we have seen this. Most of our clients are having foreign tax credits. like how the tax credits will get carried over from from 1 year to the next year, and similarly AMT foreign tax credits will also get carried over. We have already seen this 26%, 28% and all. Okay. So estimated payments of AMT are also required if the client has fallen into AMT situation. If there was an AMT tax liability coming up for prior year, we should see, do we need to schedule quarterly estimated taxes payments for AMT? We cannot say that, well, it's AMT, it's not required. At the end of the year, we'll pay that. That's the responsibility of the taxpayer to understand if they're falling under AMT situation and maybe make tax payments in advance as they would do for any regular tax liability. A credit is allowed for the amount AMT exceeds the regular tax. So this is very, very important. I don't know if this is the law in India as well, but if we are AMT in certain year, you can actually get a credit for that in the next future years, and it gets carried forward indefinitely. There's no expiry on that. So it's not like 1 year in year 2022, if there is an AMT liability coming up, it's not like we just have to pay it and forget about it and write it off as an expense. We can always carry forward that AMT credit. That means we can tell IRS that in the past years I have paid this extra amount as AMT. So in the following years, if my regular tax liability is higher than AMT, okay, if my regular tax liability is higher, that means AMT will not come up. Then for that difference, give me the credit. So that means you don't charge me more than what my AMT amount is. And that is allowed. But again, there are certain limitations on it, there are certain restrictions on it, but it is allowed. It's not like, we just pay it off and we forget about it. We can always take advantage of that AMT paid in the following years. And again, this is why this is important, because a lot of times, people or taxpayer, they may have big, huge AMT liability, but still we may design it or we may plan our, tax situation in a way for the future years that we at least we plan it in a way that we are able to make the use of that AMT credit which is coming up. And it can all be done by effective planning. We know this, say $50,000 is sitting as AMT credit. So the future years planning can be done by taking that into account. Any tax preference items. Tax preference items, that means obviously as the name suggests, any item which is going to give preference to the taxpayer. These are generally tax savings. Okay, there could be section 1202 stock. This is called QSBS. Very commonly, this is called QSBS, qualified small business stock. Section 1202, and this is a very, very, very attractive tax clause in US taxation, which says that your 100% of gain realized on the sale of stock can be completely waived off if it's a QSBS. Here it is. There are certain conditions that it has to be held for more than 5 years. It has to be a qualified small business. Now, what is considered as a small business? Would $50 million company be considered as small, or would $500 million company would be considered as small? So there are certain clauses. We need to go over that to understand what is QSBS, if the taxpayer is eligible for that exemption. But that's a different thing. We will not get into that right now. We want to just understand that if the taxpayer is getting QSBS benefit, then does AMT kick in? If yes, then how, and what is going to be the implication of that? So generally 7% of the exclusion is a tax preference item for AMT. So we have to take 7% of that, and there will be AMT income, even though for the purpose of regular tax liability, it could be completely exempt, but there will be, the AMT always needs to be calculated on QSBS. There is a limit on that. Up to $10 million, they can completely waive off the income. So this is a big, huge amount, and most of our clients will fall for this because all startups formed in US may be able to take advantage of Section 1202 waivers. This is not uncommon either. It's not a law that they have just created saying that, oh yeah, it's a nice fancy law, it just looks good on the books and all, and yeah, you can get an exemption up to $10 million, good news and all. But in reality, you're never able to use that. So it's not like that. A lot of our clients have used it. We have a lot of our clients who have paid, like, who have saved taxes on more than 5 million, 7 million, $10 million of up to of capital gains. We need to understand that's what a common person would say, a layman would say, but we as a tax professional, we should understand that can AMT come in? Then there are certain called private activity bonds and all, they are all tax exempt bonds. So those tax is not included for the purpose of regular tax calculation, but we have to see the AMT may be applicable. Percentage depletion, any excess of deduction claimed over adjusted basis and all that. Then there are some drilling cost and all. If the business is into mining or oil, gas and all, then there are certain other rules applicable to them. So we will not go into very detail into each one of them, but we need to know what are those tax preference items. This is obviously very important because this is something which will come up every now and then. Adjustments, there will be some adjustment that we need to do. What does adjustment mean? They eliminate time value tax savings, pollution control and all. Like, again, there are certain rules, the changes in depreciation method, how to calculate taxable income using regular depreciation versus what is allowed for AMTI calculation, AMT. So add any balance of regular tax deduction claimed for the year, which is normally expensed, minus expenditures capitalized, amortized over 10 years. And that's the adjustment that we need to make to calculate AMTI. So if you see, these are all time value. Time value will come up when, usually when there is a difference in the depreciation and amortization. Because maybe for regular purpose, we are depreciating over a period of 5 years. But for AMT purpose, the rule may say you depreciate it over 10 years. Take less deduction. So these are usually time value. That means it's not a complete no. But you may be able to take the deduction later, not in that very same year. It's not like a complete exclusion of that income or deduction of that income. It's just we are spreading it over a different time period. It's more like a deferred, how we calculate deferred income tax and deferred tax liabilities and stuff. So what we are saying is that our tax is deferred, but we are not saying the tax is completely gone away. It's just deferred to a different period. Okay. Let's go. Standard deduction cannot be claimed. So again, we have to, for the purpose of taxable income, we have certain income, we add up all the income, less adjustments, and we come up to AGI, and then we take a standard deduction. We will not do that for the purpose of calculating AMT. That means the income that you're putting your tax on will be higher than regular income. Certain itemized deduction also cannot be claimed. Like state, local, state taxes and all those things, or any exempt interest, home equity refinancing and all. You can take that only. So home equity refinancing is different than mortgage interest payments. Mortgage interest, we know it's completely linked to your home that you have financed, and you're paying certain EMI on that, monthly EMIs. But when it comes to home equity refinancing, you can actually take loan on your home. It's not a mortgage loan. Okay, it's just that your value of your home has gone high, so you are approaching the bank and telling them that, hey, my home is worth like $100,000 more. I need a loan of $25,000. Look at the value of my home. Can you give me a loan? The bank may say yes. That's called home equity refinancing. So now if I got a loan of that $25,000, I may use it for my home, I may not use it for my home. If you're using the $25,000 again on your home, you will be able to take the interest deduction on that. ISOs. Who remembers what is ISO and why ISOs are different than NQSOs? Anyone? Raksha? Or Garima, you remember? Is Tanya there? Yes. Any answers? What is ISO first of all? We have gone through that earlier. So I don't know.
And QSO do not qualify for favorable tax treatment.
Very good. Awesome.
They have high
Perfect.
tax percentage.
But ISO will qualify a tax preference.
Yes, ma'am.
Right?
Yes,
These are ISOs which are given, which are certain, like stock options. Both of them are stock options. Both of them are given by employer to employee as part of their compensation. But ISOs have always had a very favorable tax treatment for employees. NQSO is not that. NQSO does not qualify for any favorable taxpayer treatment. So that's why again AMT comes into the picture. Why? Because IRS is saying anyways on ISO we are giving you such a tax favorable treatment. Now you better pay AMT on that. So whenever there is a ISO gain, AMT will come up. We have to see what is the balance between the fair market value and the amount paid for the stock. That difference will get taxed as AMT. That's why they're not writing NQSOs, non-qualified stock option. Why? Because they anyways are paying higher taxes on that. Okay. Again, AMT NOL, we will not go much into that, but yes, AMT NOL can be carried forward or carried back or carried forward and all those things. But one thing that we need to understand that there is a limit on using AMT NOL. We cannot use the entire, we cannot basically bring down the entire AMTI by using NOL. What they're saying is there is a limit that only 90% can be adjusted. On 10% you still have to pay AMT, but rest of the amount you carry forward it. Then there is certain AMT exemption. We have already looked for it here. We have looked in this small table that they're talking about. Only if the income is above certain amount, you get AMT. Only if the income is below certain amount, we will get exemption. Above that amount, that means people are making good amount of money. They should be paying some kind of minimum taxes. Okay, so this is the table. This is the basic amount and all, and this is the threshold. Like above this, between this threshold and all, like there is a way of calculating. What they're saying, it's phased out at 25 cents for each dollar. Below that, no AMT. After that, we'll have to see 25 cents for each dollar. You can phase it out, and once the income reaches to 1.5, like that's a cap. There's no exemption, no phase out. Basically, the entire phase out is gone. Okay. Then there is AMT FTC. We always know whenever there is foreign tax credit, there will be foreign tax credit that you can apply to AMT as well. Every time we'll work on regular foreign tax credit carryovers and AMT foreign tax credit carryover. Do you remember that, Hemant and Sai? You guys are working on FTCs for regular tax and AMT tax. Right? That's an exercise that you guys are doing, taking the carryover amounts and putting that.
Yes, ma'am.
Right. And then minimum tax credit. What does that mean? A credit is allowed for AMT paid in a tax year against regular tax liability in one or more subsequent years. Now, this is called MTC. It can be a bit confusing, AMT, MTC and all, but AMT, we should be knowing that this is alternative minimum taxes. If your tax liability is extremely low, IRS will just kick in some number saying that, hey, you pay minimum so and so taxes. And that becomes AMT. When we end up paying AMT, what we get is MTC, the tax credit that we can use in future years. Now, how can we use that and all? There is a way for that. There is a different method for that. But what we need to conceptually we need to remember is MTC is something that we can take advantage in future. The MTC amount is how to calculate that MTC amount. Again, it's not going to be that easy that we just put in our numbers and do calculations and all. But let's just go through it. You don't have to mug it up. You don't have to remember it all. We just have to remember the concept. The MTC amount is the AMT that would have been computed if the only adjustment made to taxable income in computing alternative minimum tax income were those for tax favored item that results in deferral. So that means when we are, again, think about it. Everybody, all of you, I really want you to pay attention. Think about it. How do we calculate AMTI? What is the starting point? Vandana, what is the starting point? Anyone else? Muskan,
Taxable income plus standard deduction.
Perfect. That's what I was expecting. So yes, that is starting point is taxable income. Then we do the adjustment for standard deduction. We will do adjustment for some other tax favored items. We will do some other adjustments and all, and we will see what should be AMTI. Okay, then we will calculate 26% of that or 28% of that if it's above certain amount, and we'll see what is the total AMT. If that AMT is more than the regular tax, then yes, 6251 form, boom, you see a number there. Well, this is your extra taxes. This is your other taxes. Your regular tax is only 5,000, but other taxes $2,000 is coming up. So you better pay 7,000. So that is our starting point. But now to calculate MTC, minimum tax credit, we will start with taxable income only. But instead of making all those adjustments, what IRS is saying, you make adjustments only for those items that result in deferral. Deferral meaning there is a difference. What is that called? What is the difference? Garima?
Ma'am, which difference?
Deferral. Adjustments need to be made for deferral amounts. What is meant by deferral? Sakshi, can you explain?
Future amounts, ma'am, like in further tax periods?
Exactly. That's time value tax savings. That's time value tax savings. Right? You anyways have to pay the tax some or the other time, but it just gives you some more time. So basically, you're saving your time. Right? You're getting value for the extra time that you get. If the depreciation is reduced from 10 years to 5 years, you're claiming all your expenses in 5 years. Otherwise, you would have claimed your expenses in 10 years. So the difference is only for the time. And we have to calculate, obviously, the time value of that amount and also, yeah, that is called deferral. So what they're saying is when you have to calculate MTC, do not talk about the exclusion items. Like what is exclusion? Can anyone give me an example? I need Indore team to give some example now. Give me an example of complete exclusion of item when you're completely saying that, okay, fine, I'm going to exclude this income. 100%. Okay, if you're not giving that, we'll pass it on to somebody else. Who wants to take that? You get extra 5 points.
Ma'am, meaning of exclusion.
Now you're asking me to explain the entire thing again. there can only be two kind of tax savings, right? One is that instead of 5 years, you get 10 years to put your income for taxes. Other is that you completely say that the IRS allows you to completely waive off that amount. That is called exclusion. We talked about 1202 stock. We talked about QSBS. We talked about standard deduction. Standard deduction is a complete exclusion of income. They are not saying you take standard deduction this year and add it next year again as your income. That is complete exclusion. Capital gain exemption, QSBS, that's complete exclusion. They are not saying, okay, you get a $10 million exemption. Are they saying you take 10 million now, but in next 10 years add 1 million extra to your income and pay taxes?
State and local taxes.
Yes, perfect. State and local taxes, property
Tax
taxes.
exempt interest income.
Exactly, tax exempt interest income. There is no deferral there. It's a complete tax favored item. Tax excluded item, I would say. Tax excluded item. Okay, so what they're saying is whatever items we have to put them into two different buckets. What is that which is giving only value, some savings now, but later on it will get taxed? That's one kind of item. Second is, what are those items which will be completely non-taxable? Ever. Those are these items that we just spoke about. Exempt interest income or other deductions and all. Okay, so this is how we, and again the software will calculate all of that, but we need to understand, right, what is it doing and all. We cannot be completely blind to that, okay, fine, I have just put in the numbers, let it do it. Then we are tax practitioners. We are not like data entry people where we say we just put in the numbers, let it generate whatever it wants to. We need to understand what it is doing, why is it doing, what are the rules. Software may also make the mistake. At least if you know the rules, you can go and double check it. Okay, so this is how we calculate MTC and all, and that MTC will give you a credit next year. So what happens? Just stopped here, but yeah, they're not talking about here. But okay, I'll give an example. 1 minute. Let me just try to go through my notes and see if I can come up with an example. Okay, let's do it here. So what we're going to do, you can see my screen, correct?
Yes, sir.
Okay. So let me put it this way. So in year 2021, let's say the AMT liability, okay, was 19K, right? And let's assume that before 2021, taxpayer never paid it. Let's see that, okay, maybe let's assume that married filing jointly. These people are doing married filing joint returns. For 2021, their AMT liability is coming to 19,000. To make it simple, we will assume that never in their life before 2021, they ever got any AMT to pay off. Okay, this is the first time AMT they are getting it. They now, let's assume that they are recomputing their AMT. I put the wrong spelling. Okay, whatever. They're recomputing their AMT using only exclusion, like here they are saying, right? Yeah, so they're recomputing without adjustment for the following. So recomputing AMT, okay, this way, without exclusion, maybe I'll put it. Without adjustment for the following exclusion. Okay, again, they're recomputing it, and if they do that, then let's say their liability comes to 8,500. Okay. So now they're going to file 2022 tax returns. So, but they are paying this amount, actually they are paying this amount. But what the rule says that if you have to see what your MTC will be, what your minimum tax credit is, then you again compute your AMT using the items that result in deferral. So do not use the exclusion item. So they will do all that adjustment, and they are saying that without exclusion it comes to 8,500. So now they have a, let's say in MFJ they are filing in 2022, let's say their regular tax liability is same. So the regular tax liability is 45, but the minimum is 42. So obviously he's paying 45. There is no question of AMT. Fine, go ahead, file this return, pay 45. That's one story. But what is IRS is saying? Hey, last year you had paid 19,000 in AMT taxes. Take advantage of that. How will you take advantage of that? You cannot just reduce entire 19,000 by this, from this 45,000. So this is called minimum tax credits. So what is the difference between AMT and AMT regular and AMT without exclusion? All right, let's do that. 19,000 less 8,500. How much it is?
10,500.
Okay, 10,500. I hope everybody is able to follow until here. Now, you tell, my question is, what is the MTC carryover to 2023? What are they using? Out of this 10,500, they have credits. What are they using in 2022?
3,000.
MTC used in 2022. That will be equal to 45 minus 42. 3,000 they are using. So what is the carryover to 2023?
7,500.
Minus 3,000 is used actually. Okay, again same kind of situation comes here, where this is say 47,000 and this is 42,000. Then how much will they be using? MTC used in 2023 will be?
And 5K.
Huh?
5K.
Perfect. 5K. So carry forward to 2024 would be
2,500.
This is again a very unique clause that IRS gives, that US tax has, that you can take MTC credit, or you can take MTC, which is minimum tax credit, or you can use your AMT paid in prior years to compute what your AMT credit would be. Typically, that AMT credit is called MTC, minimum tax credit, and the way tax credit is calculated is going to be different than the way AMTI is calculated. That's why they are saying we need to understand what is the adjustments that we are doing, first of all, between taxable income and AMTI income. Complete exclusion versus deferral. Okay, and then you use deferral items only, and then you compute what your AMT would be if you are using only deferral items. Then you will definitely come up with lesser AMT. This is always going to be less. This is always going to be less than regular AMT liability. Why? Because we are reducing our income now. When it comes to claiming tax credit, IRS is saying, okay, reduce your income to compute MTC. But when we have to pay AMT, they're saying, okay, you add up all your adjustments and preferred items and everything, just bring it to the maximum possible level and then compute your taxes. I mean, unfortunately, that's how tax laws are, but at least they are giving a provision to, use this amount later on in the future years. So there is a huge planning that can be done around this. If we know that they're going to have MTC credits or the minimum tax credits, you can always see, you can do some planning for the next future years and see what is going to be the regular tax liability, what is going to be the AMT. If there is a difference between these two, can they reduce their income? whatever extra they have paid here, out of that, what is the max that they can take advantage in the future years, and work around that. Okay, so we'll end it over here. Next class we'll continue with other taxes. There are a lot of other taxes and all. I mean, AMT is also kind of other tax, but we have more taxes to go over, and that's what we'll do. Any questions and all?